Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate speak into something you can actually understand. Today, we are diving into a report from the Federal Home Loan Bank of Boston, and no, it doesn't involve them foreclosing on a giant tea party. But before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss these filings with other finance nerds. The main thing to know is that this Form 8K tells us about the bank taking on some new debt. It's basically a notice that they're borrowing more money, which is pretty normal for a bank, but it is always worth checking out. They are talking about something called consolidated obligations. It's a fancy way of saying bonds and short-term notes that they sell to raise funds. All the federal home loan banks are on the hook for these debts together, meaning if one can't pay, the others have to pitch in. This section is all about letting everyone know the Federal Home Loan Bank of Boston, which they call the bank, gets most of its money from selling debt securities. These securities are called consolidated obligations. Think of them as IOUs. These IOUs are the combined responsibility of all 11 federal home loan banks. So if one bank can't pay, the others have to cover it. That's joint and several obligations, which means the banks are responsible both separately and as a group for the debt. The rules for these banks are set by the Federal Housing Finance Agency, a federal regulator. These rules even allow the agency to make any of the banks pay back the debt of another. The main point is that the bank is tied together with the other banks when it comes to paying back these debts. It is very important to remember that these debts that they are talking about are not backed by the United States government, but only by the financial resources of the banks in question. Now let's get into the details of the new debt before looking into Schedule A. It is important to read the notes that the bank has. First, they are saying that even though these debts as a whole are important to the bank, they are not saying that one particular debt it will be that impactful. Second, they are saying that these schedules do not contain information about interest rate exchange agreements, which are deals to manage how payments are going to be made. Another crucial thing to keep in mind that the amount of debt they are reporting now won't tell you if the total debt they owe as a bank is going up or down, because they might be using this new debt to pay off old debts. To be sure about what their total debt is, one has to look at their regular reports to finally note that the amounts of debt listed on the schedule are at par, meaning the face value of the bond, and they do not take into account discounts or premiums that might have affected the actual cost to them. Like how buying a candy bar on sale is nice. Now this table shows all the new debts the bank is taking on as the main borrower. So let's look. On July 2, 2025, they made a deal to borrow $15 million that will mature or come due on July 2, 2025. They made a deal to borrow $15 million that will mature or come due on July 7, 2028. Note that those obligations will come due in 3 years. The bank is paying an interest rate of 4.0%. So in around 9 months, the obligations will come due in 3 years. The bank is paying an interest rate of 4.4% on it. One that same day, July 20, 2025, they made another deal on July 3, 2025. They made another same day, July come due in 50, meaning this obligation will come due in about 5 years. It will have a fixed interest rate of 4.8% on this sum. On July 3rd, 2025, they agreed to borrow $2 million, 5 pin to only 5. They made a deal for $30 million to due housing. The short point is Dofadi, meaning this obligation will come due in about 5 years. It will have a fixed interest rate of 4.125%, again on July 2, 2020. It's important to understand some of the terms they use here. When they say optional principal redemption, it means the bank can choose to pay back the bonds early. Another important idea to understand is call style. There are things like American, Bermudan, and European. Do not be fooled. This has nothing to do with the US or Europe. These are just fancy finance terms. Bermudan bonds can be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on certain dates, while European bonds can only be paid back on one specific date. When it comes to interest, there are fixed and variable rates. They should be self-explanatory. A fixed interest rate means the rate stays the same, while variable interest rates fluctuate. Looking at all this information, it seems like the Federal Home Loan Bank of Boston is doing normal bank things, borrowing money to keep things running. They are issuing many kinds of debt. The key takeaway is how closely the Federal Home Loan Banks are tied together. If one struggles, the others will have to step up. These debts aren't backed by the government. Alright, that's our breakdown of the Federal Home Loan Bank of Boston's latest debt moves. What's your take on these borrowings and what they signal for the bank's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.